There we go. All right, guys, so welcome. We've got our final Lunch and Learn for 2022. It is December 7th. So welcome, everybody. We'll say happy Thanksgiving. Hope everybody had a great, joyful, and safe one. And now we're into welcome to the Christmas season and all the other holidays that go with that in the month of December. Guys, it's an easy day for me because I've been lucky enough to have Mr. Kevin Whitlock with us today, CPA with Tedder Whitlock. He has been around, I think if I remember, it was 1982, and really is focused on real estate agents and real estate, I should say 1099s. But Kevin, I'm going to let you just kind of introduce yourself and let you run with it. And I'm going to hang around, and if I get any questions, I'll let you know, but it's all yours. Everybody, welcome Kevin Whitlock.
Great, Darwin. Thank you. Good morning, everybody. Well, afternoon or whatnot at this point. Yes, I'm Kevin Whitlock. I'm a CPA. I've been certified since the mid 80s, sometime in 86-ish, I would say. Been in this business since 1975. I started with a CPA firm right out of high school, work with the firm as an intern, or gopher, as they said back then. And went to Wayne State and drove back and forth to Wayne State every day, and went to work for the CPA firm. Learned a lot. Left that firm in 84. Did a few things here and there with different accounting firms, and then in 06 bought. Some of you may or may not know if you've been around for a while. I bought a practice that Diane Tedder had, Tedder Consulting, and merged that with the practice that I had built. And then that came in October of 2006, Tedder Whitlock Consulting. Diane had a fairly nice real estate practice with real estate professionals and real estate broker offices, and we had some also. It was a good complement, and from there we've taken off and just continued on. There's myself as a CPA, my wife is a CPA, another CPA, two other CPAs working with us. We're an office of 11, and I have another person coming on shortly, so we'll be an office of 12 beginning in 2023. So I've worked with many real estate professionals over the years. I have, some things that I can impart, some things I can help with, and happy to do that, and hopefully help you be more successful, do some forward planning. It's with us in our office, it's not just about doing the tax return for this year. It's about where have you been, where you're going, what are you planning for, and when do you want to retire, and we would like to hopefully help out with that also. As far as when I say help out with that, I mean help you plan for that when you get there. And just real quick to touch on that, clients all the time say, hey, I want to retire when I'm 65, or I want to retire when I'm 60, and I want to retire when I'm 70. And I say, that's great. That's all well and good. But when you run into a year like we have right now in 2022, and the market is down, then you need to adjust your thinking and your thought process. As I tell clients, like, look, you don't want to stop working in 2022 because whatever money you've socked away for retirement, the value is down. So you need to adjust your thought process, and maybe you hold off retirement for a year, maybe two, until things come back, until things get better from your investment side of your portfolio. And as long as you have the ability to work, maybe continuing to work and putting off retirement, isn't a problem. So I'm guessing that a lot of the agents that are here this afternoon, have been in the business for a while. Know what they're doing, have a fairly good feel for what's happening. And some of you may or may not use what we call a tax organizer. For clients that we have on an ongoing basis, we send them out in early January, what we call a tax organizer. It jogs your memory so that you know it's time to start putting your tax information together if you haven't already been working on it throughout the year, and to fill the organizer out and get it back to our office. By filling the organizer out, you put your information in a better format for us to prepare your return. Please remember that the better you give us your information, the better format you give us your information, easiest for us to understand, it makes it easier for us to do a better job for you. And that's the whole idea, is to be able to prepare a return that is, better and does what needs to be done from a deduction perspective for you. That's our idea. Okay, so real quickly, so everybody here, everybody on the Zoom call today that's working for a real estate office, for a real estate firm, You're all 1099 independent contractors. You receive a 1099 from your office at the end of the year. That's your income. There is no ability to play with that number. People always say, hey, can I do this? Can I do that? But no, income as defined by the IRS is what it is. It's what you receive from your broker. It's what's on the 1099. There's no area to play with that. That is not good from an IRS perspective. That creates a problem from their viewpoint. But the other side of that is expenses. Expenses are breathable. Expenses can go up, expenses can go down. There is latitude. How aggressive do you want to be? How conservative do you want to be? There's latitude to work with expenses. And that's kind of where I come in and people say, well, geez, Kevin, can I do this? Kevin, can I do that? And I have clients that say, you know, why don't I do this? And there's all kinds of reasons why or why not you might do something. And it depends on your personal situation. So there you go from a perspective of how does it make sense to deal with expenses? Let's see. So overall viewpoint, I will tell you that you as a business owner, and you are business owners, you as a business owner have expenses that you have to pay for to generate the income that you receive on a daily basis, monthly basis, whatever it might be. The IRS says, what is ordinary and necessary? So this gives you a base for what the IRS is looking for. What is ordinary and necessary for you to generate the income that you receive? You've got to have an auto, you got to drive, you got to have a cell phone, you've got to talk, you've got to pay your broker fee or whatever it might be in that regard. You got to pay your MLS fee, you got to pay, you know, GMAR, et cetera, et cetera. What else over and above that do you pay for? You might pay for promotional items. You might pay for advertising. You might pay for some consulting. All of those expenses that you pay to generate the income that you earn become deductible, ordinary and necessary. And then what's black, what's white, and what's gray in the middle. How crazy do you want to get? How conservative do you want to be? The more you get towards the crazy side, the more I go, wait a minute, maybe it's time to pull back a little bit and look, and do you want to get that crazy? Because how much do you want to have the IRS come knocking on your door and say, hey, let's take a look at what information you've got. And, you know, the better job you can do to make a case for your expenses, the better, you know, job it will be to deal with if there should be an IRS audit situation. All right. Okay. So as I've talked about, auto, cell phone, promotion, advertising. If you've got office equipment that you bought, your computer, if you have an office in your home, you've got your desk, you've got the things in that regard. All of that stuff is an expense. It's write-offable. It's depreciable. Okay.
Hey,
Let's talk.
Kevin, can I jump in there for a second?
Please do.
The home office.
Yes.
That I've been told over my 35 years is a quote unquote red flag as far as claiming that on taxes. What's your thoughts or what's your guidance on claiming a home office?
Okay. So as I said earlier, I've been in this business since 1975. And Darwin, you are exactly correct. Back then, in the 70s and the 80s, home office was more or less not really something that you wanted to deal with. It wasn't worth the expense. We all know what's changed from the 80s until now. We all know what happened 2 years ago in 2020 with COVID. Not many people were in the office. People were working from home. Even in our office, you know, we split our office. Some people work in the morning, some people work in the afternoon, some people work from home. So the work from home scenario, and especially for real estate professionals, because you are who you are special, and the IRS knows that. And so home office for real estate professionals is not anywhere near the stigma that it used to be or that it is now. It is more seen as how you do business. With that said, it used to be that when you wanted to deduct for a home office, you would deduct your actual expenses and you would multiply your actual expenses by a percentage, your total square foot of your house to your office square foot. And that percent you multiply by your mortgage interest, your property taxes, your utilities, the depreciation on that piece of the house. All of that stuff would create a home office deduction that would reduce your profit on your Schedule C. And the whole idea behind reducing your profit on the Schedule C is you pay less income tax federal, less income tax state, and then the one that most people don't think about, the third one is Social Security and Medicare tax. at 15.3%. You add that on to your federal tax rate. So if you're paying taxes at 12%, you're going to add 15% on top of that, and you're at 27%. So that's why
Wow.
it's like, look, let's bring that down. Okay.
So we're pretty much safe these days then.
Yes, correct, for sure. And on top of that, Darwin, I guess what I would say, about 5 years ago, the IRS said, okay, fine, we know a lot of people are taking a home office deduction. And mind you, when you take that home office deduction and you depreciate your home, when you sell that home, that depreciation that you write off on your home office is not excludable as part of the 250,000 single or $500,000 joint exclusion on the sale of a personal residence. So that depreciation you have to pick up. Now, caveat was 5 years ago, the IRS said, hey, everybody's taking home office deduction. Let's give them the opportunity to do a standard deduction. So if you're familiar with your auto expenses, you've got actual mileage to write off, or which is with or business miles, which is a standard, or actual expenses to write off. Same thing with a home office. You've got actual expenses, and now you have for home office a standard. And you put in what is your square foot of your office. It's multiplied by a specific standard that the IRS gives you, and you're done. And on top of that, there's no depreciation to pick up when you sell your residence. It's usually a smaller number as a home office deduction, but it still creates the issue of you don't have to deal with all your actual expenses. You don't have to deal with depreciation. Okay.
So here's what I just heard. I should probably get a CPA.
Yes.
Yeah. We specialize in marketing and selling real estate, not in doing taxes. So it literally is something I think we should all take a look at. And then there's a question, Kevin, regarding the home office. What if I'm renting and I don't own my home?
Okay, so if you own your home, you've got taxes, insurance, et cetera, et cetera. If you rent, you still have the rent that you pay, and the rent that you pay is in lieu of property taxes, mortgage interest, et cetera. So you still have rent expense, you have utilities that you pay, and you probably have renter's insurance. So those three things create your amounts that you would use for an actual home office, or you still have the ability to do the standard of your home office. But I guess what I would say in this case, I had a client that was a renter. She had a small apartment, 1 bedroom. Okay. The IRS rules for home office deduction is that you have a specific area that's dedicated to your office. It can't necessarily be your living room. It can't be your kitchen, and it can't be your bedroom. It's got to be a separate area. So if you've got a 1-bedroom place with a living and a kitchen, you're somewhat limited, and that may not be, that's kind of what I would say somewhat on the cusp of not a deductible thing. You got to have a 2-bedroom apartment or a, some other place in your apartment, if it's an apartment or a home that's got an additional place for a home office. Okay.
Great answer. Great answer.
Okay.
Now you might, and if you want to put this off, but I'm sure you'd probably address it, vehicles, the aspect of leasing versus owning and having a payment versus the lease payment, or do I do mileage? So up to you if you want to hit that now or if that's later.
No, that's fine. We can go through it. So again, well, from a vehicle perspective, it depends on lease buy. In the business that you're in, most real estate professionals that I know want to have a new vehicle. You want to be presenting your best self. If you are successful, then you are selling to successful people. You want to project the image. So you're probably going to have a fairly new vehicle. You're probably leasing. Leasing gives you the ability to get in and out of a vehicle 2 years, 3 years, and it's not a problem. Whereas if you buy and you don't put a down payment down, it's more difficult to get in and get out of a vehicle if you purchased it after 2 or 3 years and not be upside down. So for most of you real estate professionals, it's probably better off to lease. But if you want to buy, that's great. If you have a vehicle that's 2 or 3 or 4 years old, 5 years old, and you keep it in great condition, you keep it looking nice, it might not matter. So it just depends on personal preference. From a deductible standpoint, your lease payment is deductible. And it's really very similar, Darwin, to what you've mentioned earlier, as far as renting an apartment or a house versus buying. Same scenario. you've got your lease payment is deductible versus, and you still have your gas and oil and oil changes and things like that. You probably don't have, any tires, you don't have any brakes. All you have is your lease payment and gas and maybe, your oil changes, but nothing if you've kept your vehicle for a longer period. So you still have the same basic scenarios there. And you can still deal with mileage, and you've got the actual expenses times your business percentage, which I'll tell you for most real estate professionals that I deal with, hopefully, for most business professionals that I deal with, your mileage percentage is somewhere between 70 to 80%, maybe 85, maybe it's that high, but somewhere between 70 to 80, 85%. If you have another vehicle for personal use, the higher you go towards 100% business use on your business vehicle, that makes it more believable, because the IRS is going to say, hey, you drive this vehicle 100% for business and you don't have another vehicle. What do you do when you go to the grocery store? What do you do when you go out? What do you do when you take your kids somewhere? What do you do when you go for entertainment? So those kind of things that's why you have less than 100% deduction on your vehicle when you're writing off expenses for your business, unless you have a second vehicle. And they ask that question right on the form. Do you have a second vehicle? Okay. Has that answered your question, Darwin? Does that kind of cover what you think everybody might be looking for?
I would say yes. I believe what we're looking at then too, is, because you kind of brought it up, and I think I know the answer to this, but actual versus mileage. What or how do we do actual versus mileage? Okay.
So everybody that takes a deduction for a vehicle, you need to keep track of your mileage, period. End of story. The first thing the IRS asks when they do an audit is, hey, let me see your vehicle expenses. Let me see your mileage. Let me see your log. And that's what they want. So what I tell clients is like, look, this is December 7th today. Go get an odometer reading, take it off your car, find out where you are right now and interpolate it maybe back to 12/31. Or if you can remember 12/31, 12/30, January 1st, what's your odometer reading? In a year from now, get another odometer reading. Then that'll give you your total miles that you've driven for 2023. Hopefully you've already taken a mileage reading, or you can go back to an oil change receipt for way back February, January, and see what your mileage was on your vehicle. That'll give you your total miles, what it was at the beginning of 22, what it is at the end of 22, total miles driven for the year. Now, hopefully you're keeping track somehow, whether it's Mile IQ or some other mileage tracker software, or just writing it down manually on your calendar or on an electronic calendar, how many miles you've driven every day. Add that up for the year. That'll give you your business miles. Total miles, business miles gives you your percentage. Is it 70%, 75, 80, somewhere in that ballpark? Yes or no? There you are. That percentage to all your expenses, gas, oil, repairs, maintenance, tolls, car washes, insurance, your license plate fees, that percentage times all those expenses create your actual vehicle expense. Actual. Standard is those business miles that you had times. So in 2022, because things were what it was in 2022, we had two different mileage rates, which I've only seen that once or twice before in the past. But for the first 6 months of 2022, it was 58 cents a mile. And for the last 6 months of 2022, it was 62.5 cents a mile. So you multiply your miles times those two amounts, and that gives you your total deduction standard for vehicle for 2022. And use that going forward. Okay, Darwin, got it?
If I'm lazy, I just worry about the mileage that sells. But if I really want to see which way is best, I do both. Correct.
Now, the key is once you start a method, you've got to continue with that method until you sell the car. Okay.
There's an interesting one.
Yeah. And I don't remember. I'd have to go back and look, and I could tell you, but there is, when you start with one method, you can change to the other, but it's only one time. And I tell clients, look, if you're going to start with a method, stick with it. but there's one way that you can go from standard to actual, actual to standard, but you can only do it once, and you can't switch every year. Whatever it is, and you can flip once, and I don't remember which the IRS says you can go from one to the other, but it's only one time, period. When you change a vehicle, you can change the method. If you've got a vehicle right now and you're using standard, and you say, hey, let me look and see what it is to do actual. Let me run them both on a new vehicle that you're going to buy next week. You can do that. Let's change it. We were doing standard on this vehicle. We're going to do actual on this one, and you can get an idea and see what it is. The thing about doing actual is, if you're doing actual expenses, it's more work. You're going to depreciate the vehicle, and the depreciation of the vehicle normally runs for a 5-year period, and then it's done. So if you keep the vehicle for a long period of time, that doesn't work. But in your case, in the case of the people that I think in our audience today, most people are leasing and have a new vehicle. So that's the depreciation, and having it run out isn't an issue.
All
Okay.
right. So then the question popped in here, and I believe I know the answer, but can you deduct the lease payment and also use standard mileage?
No, it's one or the other, because remember, if the lease payment is an actual expense, and the standard mileage is standard mileage, and that's all by itself. That is one way, and actual expenses is another. So you can't deduct the lease payment and then do mileage. It's mileage or all the expenses: lease payment, gas, oil changes, license plate fee, whatever else you might have. Okay.
So, thinking about that, then I might go out and lease a $100,000 Tesla, have a $1,200 a month lease payment. I'd probably be farther ahead going actual than I would if I did the standard.
Yes, that would be true. But remember, you're limited by your business piece. But yes, you're right to a point. And the other part of that is the IRS looks at what they call luxury autos. So the more you've got in a vehicle expense, the more the IRS wants to go, knock, knock, knock. Why do you have so much? Why are you buying this $100,000 Tesla when you could go out and buy a $50,000 Chevy? Okay.
Great one. Great
All right.
one. That's why I'm glad you're here today, bud. All right. So if it's good, we'll shift gears again. And if I got you on track, you're going to answer this, you can hit it. But there's that confusing question of entertainment expenses. And I'll go along with, really business meals, because I know they switch gears on us again. And what would qualify as a business meal?
Okay.
So let's hit those two if you could.
Sure. Okay. So as you know, or those of us that have been around for a while, it used to be, meals and entertainment. That was the deduction, and it was 100%. And then the 80s, the people out in Washington decided that they knew better than we did and said, hey, we don't like everybody deducting the 3 martini lunch, and you deduct it for everybody. Everybody's having a grand old time, and it's, you're writing all that off. They said, nope, sorry, can't do that anymore. We're only going to allow you 50% of your meals and entertainment deduction. So if you had 5 or 10 grand as a total write-off in meals and entertainment for the year, they limited you to 50% of that. Okay, taking stuff away. Then they said, with the tax law change of 2018, okay, fine, we're not going to allow entertainment anymore. It's strictly meals. Done, end of story. Okay, anyway, so now we're stuck with meals only. And when you do a meals write-off, what the IRS wants to see, if they want to come and question you, there's 5 things that you need to document. You need to document where you were, when you were there. You need to document who you took, the amount, and what you talked about. 5 things. When I take people out, it's on a charge card. The charge card, the charge receipt has where the place, the date, and the amount. Flip the receipt over, put down Darwin Conley, put down, we talked about a 12/7/2022 tax conference, and there we are, I'm done. I put that with my receipts, I put it with my credit card bill, and I'm all set for when the IRS comes if they want to audit me. Having your credit card bill that says Highland House on it is not sufficient. IRS wants a receipt, and they want those 5 things. That's what you need to have for entertainment.
And I just recently discovered that it's not the credit card receipt. It's the receipt that we received with the credit card payment. Is that right?
Bingo, that is correct. The credit card bill that lists the date and Highland House and the amount is not sufficient. You need the credit card receipt or a receipt if you pay cash. Got to have a receipt, correct.
Awesome. And then just to confirm, there is no longer an entertainment expense.
Correct, that's right.
So I can't go buy Tigers tickets and write it off. Even though I'm taking clients out.
That would be correct. And I say that slowly because I guess it depends, Darwin. It depends on how aggressive do you want to be? Do you want to be a little aggressive and do you want to go buy some Tigers tickets once in a while and put it into promotion? Do you want to give them away to a good customer?
Mm.
Do you want to call it promotion? Do you want to call it advertising? Do you want to go buy some Tigers tickets and give them away as a promotional item for maybe the top selling agent of the last week or something like that?
Gotcha.
Okay.
Gotcha.
So now that's why I say it depends on, what can you do with it as far as can you make it a little different item and how aggressive do you want to be with it? Will it hold up in an IRS audit? If you have it documented that you bought these Tigers tickets and they were for this promotion that you had, it's a promotional item, it's not a gift, and it's not entertainment. Okay.
So that's the importance of having a guy like you or someone on your team that we can call and talk to through the year and ask these questions. Hey, I'm thinking of this. How would that work? Someone like yourself or your team would be able to address that for us throughout the year.
Correct. I mean, that's the whole idea. That's why I say it's not just about preparing a tax return. Anybody can take the numbers and put them on the paper or put them in the software. Anybody can do that. But it's really how aggressive do you want to be? How much do you want to really look at what you are doing? And if there's some additional abilities that you have there, those are the things that I do, just like you guys have some little things in your back pocket that you might pull out in the case of something changing or this or that. Well, let's go around it this way. Let's do an addendum on that and we can make the sale happen. In my case, it's like, let's look at it this way and maybe we can make this deduction work if we back it up with this explanation. Okay.
Excellent. Yeah. Excellent. And question came up with clarification. Do we need original receipts or would copies suffice?
Well, you're going to have originals to make a copy of at some point. So if you're going into an IRS audit, copies can work. Originals are better, I guess is what I would say.
That makes a lot of sense.
Okay, so well, hold on a minute, Darwin. Let me
go ahead.
Let me maybe address that a little bit quicker to make it a little more clear. So when you file a tax return, if you file the tax return so the return is due on April 15th of the following year, with an extension is due on October 15th. The IRS statute of limitations is 3 years. The state of Michigan statute is 4. Okay, so this is where I get questions all the time. How long should I keep records? So if you're saying, okay, I've got this credit card bill, I've got the receipts attached to it, or I've got it all in an envelope, you should keep those for probably a 5-year time period. And so I'm trying to give you some kind of, well, do I have to have originals or do I have to have copies? So if you keep at least what you have for a 5-year period, sometimes it might be 7. That way there's no chance of them coming back and you not having the receipts. Every once in a while I talk to somebody and they say, I just pay the bill and I throw the bill away. It's like, no, don't do that. No, you can't throw the bill away. You've got to have receipts. And 3-year statute federal, 4-year statute Michigan. And once you pass that time frame, they can't come back and audit you unless they find fraud. Okay, and fraud gets back to where I talked at the beginning. If you're messing with income, now you have a fraud issue. If you're messing with expenses, if it's just reasonable, you don't have a fraud issue and it's not a problem. And once your statute runs, you're probably going to be okay. All right.
All right. And I got a question here in Belleville. The credit card statement. itemized expenses.
For that, can we still use that?
Will that suffice for receipts? Having an itemized credit card statement, like I know American Express used to do that. And they itemized all of it. I'm gonna guess that will that take the replacement of a credit card or receipt?
No, you've got to have the credit card receipt. Remember, you've got to have 5 things. So if you've got the credit card bill, you'll have the amount, the date, and the place, but you won't have who you took and what you talked about, unless you've written that down on the statement.
But that's for entertainment expenses. What about for like our GMAR, our advertising, things like that, that we won't necessarily?
So all those other things like our board dues, all of the additional expenses, the advertising, would that credit card statement show for that?
Not really. I mean, it can, but it depends on what side of the bid the IRS agent got up that day. And it depends upon how well your record presentation is. If you've got a lot of documentation, then maybe you can make do with that. Maybe the IRS agent will let you do that. But most often than not, in the things I've been through and the people that I've talked to, you need the actual receipts. I mean, if you're paying GMAR dues, they're going to send you a bill. You should print that bill off and put it in your box of receipts for 2022. You know, it's a little more difficult. It's a little more difficult when you go to a restaurant. You know, I write it out, I put it in my pocket, and sometimes it gets to my envelope and sometimes it doesn't. I've got a whole stack of receipts sitting in a basket, you know, at my home, and I got to sort them out and put them away. But again, you really should have the receipt. And again, it depends upon how well put together your documentation is. Because again, the IRS person that's doing the audit, they are looking for your documentation. If you have no documentation, you're all out of the box. And if you're marginal on documentation, that makes it more difficult. Okay. I saw.
What about, oh, here's another question. This is a good one. Regarding clothing.
I talked about that yesterday. I had a Zoom call yesterday morning at 9 o'clock, and I talked about that. And I love that question because I talk about the Century 21 gold jacket, and I love that because that is a classic. The Century 21 gold jacket, I'm probably not going to wear that to a wedding or to a funeral, or I'm not going to wear it to some holiday gathering. I might, but I'm really not. But that's more of a uniform. The Century 21 gold jacket is more of a uniform. So if you have a uniform, that is deductible. It's like scrubs. You're not going to wear scrubs to a wedding or to a funeral, but you're going to wear them around the hospital. You're going to wear them for your job, and they are a requirement for what you do as a medical professional. The Century 21 jacket for Century 21 people that's what you do. That's what you wear. I don't know. Do people still wear that?
No.
Okay,
they have one, but what I used to call the old baby puke gold is gone.
Yeah, okay.
And nobody's wearing that any longer. So then now it would be more to the point of like many of us will just have a pullover that has the logo on it, like the CB with the North Star or the C21.
Right.
That
Okay.
would be something that would be.
Well, if it's a logoed type item, then yes, you have the ability, because when I buy that thing, so if I buy a whole bunch of shirts or sweaters or polo or golfing shirts, and I have Tedder Whitlock Consulting on them, I'm going to write that off as promotion. Okay, so if you're buying things that have your name and your company name on it, that's a branded item, and I would write that off as promotion. So yes, but clothes, I mean, I've got a closet full of suits. I've got a closet full of dress pants and dress shirts like today. Those are not expensible. Those are not a business write-off. No, I mean, this is just a plain old dress shirt. I got a plain pair of dress pants on today. That's not a deductible animal because it's not what did I say? It's not branded. It's got to be something that's branded.
Exclusive for your work.
Correct. Yes.
Awesome.
I mean, think
Well,
of it this, as I said, think of it, if you can wear it to a wedding or you can wear it to a funeral and you're comfortable in it. And I say that with, a little bit of
right.
candidness, but you get what I'm getting at. I mean, some
Yes.
people will do some goofy stuff but yeah, if it's branded, you're okay. If it's just a plain old suit or a plain old dress or, slacks or what it might be, no.
Okay.
All right.
So here's the question and simplest is, what about monetary support? So, or of nonprofit organizations like donations?
Oh, okay. So look at it, Darwin, from a perspective of, I guess I look at it, donations are not deductible on a Schedule C. So as I'm talking to all of you today, I'm looking for deductions and things that are going to reduce your profit on your Schedule C, because that is a direct, it's a direct write-off, but it also reduces what you're going to pay your Social Security and Medicare tax on. I mean, if you can write off your charity on Schedule A as a miscellaneous itemized deduction, great, if you have enough. But, with what they did in 2018 to raise that standard deduction for joint returns, it's $25,800 or so. If you're single, it's 12,000, 13,000 bucks. If you have enough write-off to get over that hump, that's great. But if you don't, then donations go there. But maybe you call it donation. Maybe it's a promotional item, and maybe it's not a donation to a charity. Maybe you give them something that's branded, or something that might, you might call it a promotional item, and you might be able to sell it as such. You might have some documentation that you could make it a promotional item instead of a charitable item. Follow?
Yep.
Okay.
Yeah.
Okay.
I think that's where you're again showing the value of not just doing your own taxes or going to H&R Block where all they're doing is filling in numbers for you,
Right. Yeah.
but really have somebody such as you and your team that could handle, guide, and direct
Right.
throughout the year.
So, someone asked, Darwin, I saw in the chat, someone asked, is it true that you have less chance of an audit if you file your return in October than April? And I had a client for a long period of time that would always file his return on October 15th with that thought process. And I think that thought process still holds true, because you got to look at how the IRS does things, or how they have normally done things. And right now things are really goofy there, because they're so far behind and so understaffed, which is fine for us to a point. When I try to make a phone call and can't get a hold of anybody, it's a pain, but it creates other issues. But what I'm getting at is, when all the returns get filed in April, they run programs within their servers on those returns, the bulk of them that get filed. So if they're running their programs on different items, different whatever they might do to see what returns, how they're being filed, what's being filed, to get things that kick out that are higher than a standard. When we do a return, what we have diagnostics when we do a return, it says your itemized deductions interest is higher than the normal industry standard. Your charitable contribution is higher or lower than the normal industry standard. So I have that to look at, and the IRS does that similarly. So if they're running their software in the summer, when you file your return in October, that's already done. So you've missed out on that bucket of the net for the fish that are swimming all the returns through. That net is already gone. And they've already done that. So yes, I think the answer to that question is, at least in my case and my thoughts and what I've dealt with, that's true. If you file your return in October, you have less chance of an audit than you do in April.
So procrastinators have been benefiting and they didn't even know it. Hey,
Okay.
I got a couple more in here. One that came directly to me. So this is actually an interesting question. If I send all my receipts to my tax person and they write off all these things, who would be responsible? I trust he is writing off what is legal and what I provide.
That's a good question. From our perspective, if I've got a client that sends me their listing of, well, I guess it depends. You know, I'm looking for a listing of your expenses. I'm not looking for receipts because I'm not going to sift through all your receipts. You don't want to pay me $150 an hour, $200 an hour to go through your receipts and add them all up. That's not what you want to do. It's too expensive. You want to give me totals is what I want. So I'm assuming when you give me a total for advertising or you give me a total for promotion that you've gone through and added it up, and those are reasonably deductible expenses. You've paid ABC Mail It Company for 12 months of mailers throughout the year, and that's your advertising expense. Or you've paid GMAR for the dues and you've got your bills. Okay. I mean, I can tell you when I look at returns, if something is way out of whack, if something doesn't look right to me. I've done enough real estate professionals returns where I can get a pretty good feel, you know, what the numbers are. And I do a cursory look at past, and I do a cursory look, you know, forward as to what you're doing and where you're going with your business. If you have a whole lot of deductions in one year and your income is down, but if we're looking at, I'm looking at 2022 returns for clients right now and doing tax planning. So I've got a client that last year he was at 130 grand in gross receipts from home sales. I'm talking to him today and he's at 375. Okay. So if you had deductions that you were doing things and changing things in 2021 that created the additional expenses in 2022, then I would write that off in 2021. And that's why I'm asking and talking and asking questions of my client. I do take returns and I do just put numbers on the paper sometimes, but it's normally when I have a client that I've dealt with for a long period of time. I know what they do, how they do it. And I might, when I'm done with the return, I'll call them and say, hey, what about this? Hey, what about that? Did you think about doing this? Do you want to make a retirement plan contribution? What about an HSA contribution? Have you set up anything for your children for college education? Those are the things that we get into. Okay, does that help?
Excellent. Yeah, I think that answered quite a lot there, actually. And one other point of clarification toward I think, what category do we put this under? But here's, what if you're a sponsor for a charitable event or for something with the school? Is that then a promotion? Where would you classify that?
Good question. I'd probably have to know more. I'd probably have to get a little bit deeper into it, Darwin. You know, I think of a charitable contribution as, you know, you're taking money out of your pocket. You're writing a check out of your bank account and you're giving it to a 501c3 charity. If you are sponsoring something,
Let's say a youth basketball team.
yeah, if you're sponsoring and paying stuff for a youth basketball team, so maybe you're buying basketballs or maybe you're buying jerseys. So if you're buying jerseys with a number and maybe your name on the back, that's going to be a promotional item is what I would call it. Because again, how is it being branded? How is it being used? Are you giving it to a 501c3 or are you giving it to buy something for a team or giving it to buy something for the event that you're putting on for a charity? Okay. Does that make sense? Does that answer somebody's question? Does that kind of get?
I believe that you did. And again, there's never a straight answer until you know the details to it. And it would be, let's make sure I've got somebody to be able to ask that question to who would know. But
Correct.
yeah, the quick clarification, whole sponsor for a charity golf outing.
Yeah, I mean, I do those all the time. That's just promotion, advertising or promotion. I mean, when I do a Women's Council of Realtors and I give them, you know, money for a whole sponsor or whatever it might be, that's just a promotional item for me. It's either advertising or promotion.
Awesome. Awesome. So, you know, I happen to think about one, so I'm going to jump back and go to the mileage.
Okay.
I know this is a big question that's come to me over my 35 years. What mileage can I actually deduct? The principal one is I leave my home.
Okay. So to answer that, again, you as real estate professionals, if you have a home office, that is your office. So I'm here in Livonia in my office. I live out in Highland. My 25-mile drive from Highland, Michigan to Livonia, Michigan is not a deductible animal. My office is here. This is where I do business from. When I go from here to a client and I come back, that's deductible. When I go from my office to here and then to a client and then home, I've got some deductible mileage there. Okay. From the client to my home is probably not going to be deductible. From my office to my client is. Depends if I go from my office to my client and back, that's all deductible. But I go from my office to my client and then home, from my client to my home is not. Think of it like this. I drive 23 miles each way. So if I'm driving less than that in going to a client, just from my home to my client is going to be deductible. And if I've only, driven 40 miles instead of 46 miles, I'm not going to get away with deducting, the whole 46 for that round trip. Because they're going to look at that. The IRS will ask those questions. And on the form, it says total miles, business miles, what are your, key word here, commuting miles. In my case, it's 46 miles a day. Okay. In your case, if you have a home office, which most of you do, your commuting miles are a big goose egg because you're at your office. If you're going to show homes, if you're going to, your real estate office, if you're going to the bank to deposit something, if you're going to the bank to, pick up, whatever it might be or whatever you might be doing, that is a business expense as long as it's relating to generating your income. Okay.
Absolutely. So then a little further clarification. What if I do have a home office and I have an assigned office in the company building or even a desk in the building? What then?
Well, because you are who you are, because you're Darwin Conley, you are special.
Everybody else thinks that too, but maybe not in the same way.
That's right. That's right. But let me broaden that umbrella out and say, because you are real estate professionals, you are all special. And the IRS gives you the ability to do a home office, even though you may have an office or a desk or a place to do business at your broker's place of business, at your broker's brick and mortar location. Okay.
Excellent clarification.
But I guess I would say, you don't want to go crazy deducting all kind of mileage that's marginal. Because again, auto expenses is a hot item ticket. Auto and entertainment or auto and meals, have always been a hot item ticket for the IRS. They know that people don't keep records. They know they don't keep good records. They know they can always pick something up there. So that's where they always go. All right.
So let's see, there's a couple of them. It's good that we prepared for today, wasn't it?
It was. I got a whole sheet of things here, and we are getting to them eventually.
We might have to do this again sometime.
Fine by me.
So is there like any leniency to having the receipt? And here I'll give you a little foresight to that question. There was a time when people said that if it was $75 or less on a meal receipt, you didn't need the receipt as long as you had your who, what, when, where, why.
That's called the de minimis rule. And that normally takes place when you are away from home. So my daughter, who works for PwC, is in the audit department. She's currently in Milwaukee. And so she's away from home, and they give them, there is a standard de minimis amount on a daily basis for meals. That's, I think, what you're referring to. So it's normally, that's normally an away from home item, not if you're in your home area. Okay.
So if we do a business trip, say to one of our conventions, then you might, but it's sounding like, no, you'd still better have your receipt.
I would. Yeah, I would.
Okay. That makes a lot of sense. So another question that's come up, shifts a little bit of gear, but in regards to a client gift, what is the maximum amount for something labeled client gift?
$25. Now you tell me what you can buy for a client that's a gift that's worthwhile at $25.
So then what if you're over that amount, or maybe what else might I be able to classify that as?
Okay, I'm gonna give a gentleman a plug that I know wanders around, and I use the word wanders in an endearing fashion. He makes appearances and he is at a lot of real estate gatherings. And his name is Luke, and he sells Cutco knives.
Uh-huh. Yeah.
Those Cutco knives would be branded and say Darwin Conley or Brenda Davis. At that point, when you give me one of those one of those Cutco knife sets that says Brenda Davis on it, that is a promotional item. That's not a gift. Or it's advertising, not a gift, because it's branded.
So the key to our gifts, make sure they're
Right.
branded.
Make sure they're branded. Correct. Yep.
Well, if it's got, more than likely, so Kevin, does it need to have the company brand or logo on it, or could an agent just have their name and say phone number, email?
Yeah, yes, that, so the second, Darwin, if you had your name and your phone number on it, you had your name and your office address or something, if certain things you can only, you only have so much space. So from my perspective, it's a name and a phone number, and somehow you might have some kind of a realtor, maybe you put the realtor R on it or something. But again, if you're in the business that you're in, you're a real estate professional, your name and phone number is the main thing that you want. And if that's on a gift that you give away, that's the key. If you just give somebody a gift card, that's a gift. If you give somebody $100 gift card, that's great, but it doesn't say Brenda Davis or Darwin Conley on it. It's just a gift card.
Mm-hmm.
But the thing that I can, or maybe an umbrella, with Darwin Conley or Brenda Davis on it.
Yep.
That's more of a promotional item than a gift.
So here's a question, shifting gears. I like this one. How do I take advantage of my kids? She didn't word it that way, but what can we do to actually give them money that becomes deductible? And how would we actually justify, and I know that that can be done, but how would we justify that for work that they may do for us?
Okay. I do this all the time, and I see it all the time, and I get this question all the time. And it's a great one, and I love doing it. So first off, you've got to have a child that is old enough to do whatever it is they're going to do. You can't have a 2-year-old licking envelopes and licking stamps and send them out in the mail. 2-year-old can't do it. But if you have a 10-year-old, 11-year-old, 12-year-old, 15, whether they're sweeping the office, whether they're running the vacuum, whether they're doing mailing, whether they're emptying the baskets, whether they're doing whatever else maybe you have a list of your customers, a list of your clients. Maybe they're going through the list and they're, bringing up people you need to communicate to. Whatever you might have for them to do, they've got to be old enough to be able to do it. I get this all the time, and I've got, can my son or daughter do this? Well, again, they have to be old enough, number one. Number two, you've got to look at whether they're a subcontractor or an employee. Now, if it's just you in your business and you don't have any other employees, then they're going to be a subcontractor. Okay. I would prefer that they were an employee, but it's not worth the time and the effort and the cost to have them be an employee and set up payroll and pay for the cost of doing that, for the benefit you're going to get for putting your son or daughter on payroll and giving them $6,000 or $10,000 a year. It's just not worth the cost. So what you do is you set them up as a subcontractor and give them a 1099. And this is going to be some tax-free money for you. This is huge. You're going to pay some tax, but it's still the tax benefit of what you're getting is just huge. So when they changed the tax law in 2018, single taxpayers, which is what your children would be, you can earn up to about 12 grand-ish, whatever the standard deduction is for single. It's 12.5, 12.9, something like that right now. They can earn up to that amount of money and not pay any income tax, federal income tax. You're going to pay some self-employment tax on it, Social Security and Medicare, and you're going to pay some state of Michigan tax on it at 4.25%. But you, as the real estate professional, are going to deduct that $6,000 on your return, and you're going to pay less federal tax at whatever your tax rate is. You know, even if they had to pay tax on it at 10%, it's better than your rate at 22%. Okay? Does that help?
That is a perfect answer.
Now,
Hey, what?
hold on one
Yeah,
quick
go
minute.
ahead, Kev.
If you do have an employee in your business and you already have payroll, then it makes sense to put your child, if they're 17 or under, on payroll, because then there's no Social Security and Medicare tax on that. But you have to have payroll. Okay.
Excellent.
So payroll,
Hey,
subcontractor, 1099. I guess the huge key here, and this is one of my talking points. If you have someone, whether it's your child or you have an assistant doing work for you, and you pay them more than $600, you must give them a 1099. It is an IRS requirement. There's a question right on the tax return. Did you have someone work for you that you paid more than $600? Yes or no? If the answer is yes, the next question is, did you provide them a 1099? Yes or no? IRS requirement is that you give them a 1099. That's a requirement. If you answer that question no, what do you think the IRS is going to do? They're going to come back and say, hey, you can't deduct that 10 grand that you gave to John Smith and didn't give him a 1099. That means that you get to pay the tax on that income or on that expense, because they're going to disallow it. Okay, 1099 is very important.
So let's see if there's a quick answer for the next two here. What's the average meal deduction for those agents you've worked with?
Gosh, that's all across the board. And it all depends on, agents. It all depends on what an agent's income is. I've got agents, doing $500,000 in income. I got agents doing, $50,000 in income. It's going to be commensurate with what your income is.
So it'll truly vary, and IRS, I would have to think it would look at that also then.
Correct. Yep, they will. I mean,
right.
if you've got 50 grand worth of income that's on your 1099 from your broker, and you've got 20 grand worth of meals, 15 grand worth of meals, it ain't happening. I mean, what's
Yep.
Now, this might get back somewhat, Darwin, to what I talked about earlier, as far as I've generated a lot, I've spent a lot. And if I'm talking to you right now, if you spent a lot and we deducted a bunch in 2021, and your income was 50 grand in 2021 for whatever reason, but then your income is 400,000 in 2022. Okay, I'll go along with that. I'll see that makes sense. That's why it gets back into discussion and talking about what's going on. Okay.
So here's a quick one. Home warranty. What category does that go for when I, as a real estate agent, pay that for a buyer or seller?
Home warranty expense. We just have a line item, home warranty expense.
Direct deducted to it.
Mm-hmm. Yep, exactly.
Let's see, when we put things on our agent bill, the answer to that one is yes. Matter of fact, it should actually be on our agent bills anytime that we have an expense. So it just depends on which brand you're with and how that shows up on a line item for our office bills. So Kevin, I'm showing about 1 minute left. You got anything on how you want to wrap this up?
Yes, real quick. I mean, so as I talked earlier, if you have income in your real estate business, to me, it's very important that you provide for your retirement and put some money away, either into an IRA if you have a profit from your business, or into a SEP, or make a SEP contribution if you have profit in your business. You will thank yourself when you get down the road and you want to retire. Other thing is, if you have a profit in your business, you should be making estimated tax payments April, June, September, and January throughout the year, so that you're not getting a tax bill in April of the next year that's 10 grand and you don't have the funds to pay that. You need to pay your estimated payments as you go throughout the year. There are ways to put money away for children, for education. There's not a federal deduction. There is a deduction if it's a state of Michigan MESP account. You can do that. Let's see, highlights of what else it might be. You can talk to your clients about a 1031 exchange if they're looking for some ways to deal with it. There's a $250,000, $500,000 exclusion for the sale of your primary residence every 2 years. So if you can do things, if I don't know many people that can, and I can't buy and sell a house 2 years later and go into a new place and continue to do that. But if you can, and you're the ability, and you're in your your realm, you're in your business of what you do. If you can buy and sell every 2 years, if you're gonna have a gain, that's tax-free money in your pocket on the gain on that house every 2 years or 3, whatever it might be. But I'm talking about a short window. You know, I think most people keep their homes for 7 years, 10 years, whatever the standard is, whatever the most, whatever the range is for what people keep. If you can do it and shorten it up and put that money away in your pocket, it's free. I think that probably covers
Fantastic.
most all of it. I'm always happy to do, if you have questions, you can send me an email. My email address is kwhitlock@tedderwhitlock.com. I'm happy to field an email. I can, if you have a question, I'm happy to help you out.
And Kevin, we were a little bit more focused about we as real estate agents than even thinking about the tax benefits that we might address with our clients. So
Mhm.
we might have to ask you to come back around again and maybe talk about the 1031 exchange or
Sure.
other benefits that we've got throughout the year here. So guys, we put everything out there. Kevin, you want to give your the phone number again one more time?
So our phone number here is 734-542-4200. And my email address is kwhitlock, WHITLOCK, @tedderwhitlock.com. Okay,
Fantastic. Kevin, thank you. We appreciate your time. Round of applause from here in Belleville and around our company. And fantastic information. I put you up here at the top with the best what we've had this year, Kevin. So thank you
Appreciate it.
again for your time. Everybody, thank you. May not be seeing you. If not, we wish you all the merriest of Christmases. And by the way, remember, our activities today are our income 90 to 180 days from now. Make sure that you're getting ahead of this market with your income and do not become the casualty of this market. Go talk to people. We'll see you guys. Be blessed. Bye-bye.
Thank you.